As data has taken a back seat in driving markets, hype around artificial intelligence and big tech has taken over. Is that still going to keep going? It's been a tough month so far for two of the biggest names in tech, Apple and Nvidia. Both stocks have pulled back. They're possibly heading into correction after posting massive gains in the months prior. Keith Lerner is still with us. Keith, tech is one of the sectors you like. Mm-hmm. So presumably you're not so worried about the pullback in some of these large cap names, or how are you framing your thoughts around it?
We upgraded tech in March, and the way we're thinking about tech is, as you think about it intermediate term, if the economy does slow down somewhat, we still think some of these rate hikes are going to have an impact. I think it's been delayed. That companies are going to continue to have to pay on tech spending regardless, so just to keep up with the competitors, or they can be left behind. So I think tech's okay. I think the problem with tech, as we all know, it got top heavy. We had 40% gains in the tech sector. And I also think it needs a resting period. So, I mean, short term, after Apple's earnings last week, it feels a little bit heavy. So we just think it's also going to be, consolidating here. I think the overall long-term outlook looks stronger. Technical trends have weakened here a little bit. And I think that's the other challenge with the market. You asked earlier, what's the catalyst to move this market much higher? You need tech to re-engage, right? Because tech, communications, discretionary are about 45% of the market. So if you say what's going to move the market higher, you need that to re-engage. Maybe the big catalyst to be watching is, I think August 23rd is Nvidia's earnings, right? Mm-hmm. That kicked off wow, this AI is really potentially real in some ways for earnings. So they have a high bar to pass, but that's the other thing we'll be looking for. And in the interim, what we've been doing really since June, the average stock, the equal weighted index, had underperformed the S&P on a 3-month basis by the most we've seen in about 30 years. So what we've been doing is say, hey, S&P 500 still fine. We still think there's modest upside, but pair that with something like the equal weighted index, where you have not so top heavy, which are trading around the 15 multiple, has had a lot of underperformance and maybe a little bit mean reversion. And you're seeing over the last week or so, financials acting a little bit better, energy acting a little bit better, and that should benefit something like the equal weight index.
I mean, there's a lot of kind of a show me narrative now that investors are applying, even with the AI narrative that had been driven in the hype phase that came in the previous earnings period. And so now in this one, it seems like there's a little bit more scrutiny around, okay, when is this actually going to trickle through to your bottom line for some of the tech companies?
Yeah, you're right. I mean, at the end of the day, I mean, the hype is there, but after a quarter, 2 quarters, 3 quarters, it's like, show me the money, right? Show me that in earnings.
And how much is going out.
And how much, and I think we all agree it's revolutionary, and what you do, what I do, is going to be supportive for a lot of, there's going to be a lot of great productivity gains. But how does that translate in earnings? And, our tech analyst mentioned with Nvidia's capturing the majority of that AI earnings boom right up front. Where do we see the follow-through from others? So again, we think it's a positive. We think that the valuations will stay somewhat higher than normal because of that expectations, but those earnings may not be coming through right away. It's going to be a longer-term process.
And you are keeping your overweight.
We're keeping our overweight. I mean, again, on a short-term basis, some of our tactical strategies, we're keeping a close eye, but someone has an intermediate time frame, let's say, 12 months, we still think tech is just fine.
And then another one you're overweight, not as sexy, industrials. What's the thesis
I think
behind
industrials
that?
Is very sexy. I mean, it really benefits from a lot of secular themes. I mean, one, onshoring. We've seen a massive amount of spending back in CapEx here because of the onshoring. And then the other thing that's still underappreciated, a lot of these stimulus bills, as far as the IRA, the CHIPS Acts, there's so much kind of stimulus that's still in the pipeline that hasn't even gone through yet. And I think that the industrials will be a beneficiary of that, not just this year, for several years. And then also defense spending, right? We still have the strategic battle with China. So defense spending starting to ramp up as well. So I just think it's a diversified area that benefits from some secular trends. And I really think that's long-term leadership. By the way, an interesting factoid is 2 sectors actually made a new all-time high over the last month or so, and that was tech and industrials. To me, that's a sign, especially with industrials, that's probably longer-term leadership.
And one other area as well that you're focused in on, and we've heard even more calls around this recently, small caps, and the comparison here of U.S. small cap or global U.S. small caps versus some of the large caps out there. Why is that?
We're staying with the large caps. We've been overweight large caps. We're neutral small caps right now. And the way we think about it is this: small caps are cheap. They're at a really cheap valuation relative to large caps. Valuation is not a catalyst, though, right? So when we look at, for some of our clients that are looking at 5 and 10 years, and our work suggests small caps will outperform, a higher probability. But on a short-term basis, I think some of the business cycles working against them. And don't forget, a lot of these smaller companies, they're more affected by these higher interest rates, right? So they're not as diversified businesses. So again, neutral shorter term, for folks that have a longer term outlook, we definitely think there's a part in a portfolio, but we just don't expect near-term outperformance.
And then one other area that sticks out to me is consumer discretionary, that you guys are overweight. And this one's really interesting to me, because there's some headwinds, it feels like, in consumer discretionary. The student loan repayment coming back. There's been quite a big uptick in promotioning, at least when I think about retail and apparel specifically, although I know consumer discretionary is bigger than that.
Yeah.
So
it's an interesting sector because we say the consumer discretionary, and then you say what's in there. It's actually I call it a quasi-growth sector, because your biggest holdings are Amazon and Tesla. So when you think about it, we kind of put that in the growth aspect, and those weightings in that index is so high. So it's not as straightforward as just saying, hey, if you think the consumer is going to slow down a little bit, why would you be positive on discretionary? So I think it has a mix, and some of those areas outside of those two big cap stocks, they've gotten beaten up pretty well. So again, I think overall and we just saw Amazon had a really strong report. Again, not recommending individual stocks, but it's helping that sector as a whole.
All right, a lot of sectors we've covered here today, and it sounds like we're going to fire up the hat machine, make industrial sexy again. Keith Lerner, thanks so much.
Can you help me?
Chief Market Strategist over at Truist. Thanks so much, Keith. Great to see you.
Great to be with you.